Welcome back to the VantagePoint Learning Center. In this lesson, we will cover risk propensity, determining an entry point, setting stops, and using the predicted high and predicted low indicators. Preserving your trading capital is easy to understand, but often difficult to do. This is where your risk propensity will come into play. You need to be prepared to have those losses along with the wins. One aspect of money management is developing a trading strategy and sticking to it. By being consistent with a trading plan that balances your risk propensity, market knowledge, and technical analysis, you'll be able to identify what works well for you and what may need to be changed. We believe that disciplined traders do not chase the market. Instead, they look for opportunities where the risk versus reward is in line with their trading criteria. It is important to choose your entry point wisely, and VantagePoint's predicted next day high and low are often used for guidance for entry points. Since the next day predicted high and low are not absolutes, many traders use their own judgment when interpreting them. It is common that VantagePoint users will enter a buying position somewhere at or above the predicted low and a selling position at or below the predicted high. It is also a common trading practice for traders to not enter a buying position if the price is already above the midpoint of the predicted range, or enter a short position if the price is below the midpoint of that predicted range as well. It is ultimately up to you to determine how you will apply common trading practices into your personal strategy. Once you've decided to enter a trade, many traders feel it is a good idea to protect the position using stops. Stops are another important aspect of money management and attempting to limit your risk. By setting a stop, you are deciding how much money you are comfortable losing should the market go against you. If a market is bullish or trending up, you may want to use the next day predicted low as a guideline for placing your stops. Depending on your risk propensity, you can set your stops at or below the predicted low, thereby protecting your profits without running a high risk of getting stopped out too early. Likewise, in a market that is bearish or trending down, you may want to use VantagePoint's next day predicted high as your guideline. Depending, once again, on your risk propensity, you can set your stops at or above the VantagePoint predicted high, protecting profits without running the risk of getting stopped out too early. Now, how far above or below VantagePoint's predicted next day high or low is ultimately up to you. We suggest applying a strategy to a paper trading account for a while to understand how your gains and losses will be affected. Once you're comfortable, you can try real trades in the open market. This concludes the tutorial video on setting stops, entries, and money management. For additional training tutorials, please return to the VantagePoint Learning Center. Thank you.